Canvas, so you'll be able to see the recording there. And let's jump up the slideshow. Okay, and so what we've been doing so far is just understanding assets, liabilities, some basic principles, stockholders' equity, some basic principles, economic entity assumption, all that sort of stuff. And that's just sort of the stage of getting our feet wet in the world of accounting. Okay? What we're going to start with this class, with this chapter, is now getting into the nuts and bolts of the process of preparing these financial statements that we've been talking about. Okay, so we're going to get a little granular as we move forward here, and this is sort of the more tedious part of this class. Now, it is important that you go ahead and, jump into the deep end of the pool on this, or the cold end of the pool, whatever. I used to use the example, get into the hot tub and just jump in, but somebody told me that wasn't an appropriate example anymore, so I'm going to go with the cool side of the pool. Okay, you're just going to have to go in and get yourself to start to understand this stuff. Okay, so if you sit there and try to resist it, it's going to make this class very difficult for you. It's going to be a tedium. It's going to be, oh, I don't understand what's going on. How are you supposed to do this? Okay? If you go ahead and you submit to the rigors of understanding these basics, it takes you about a couple of weeks or so to get used to it, and then you're like, oh, I got this, and everything is much easier for you from there, much more understandable from there. Okay? So you've got to be prepared to go through understanding double entry accounting. Okay, double entry accounting says that every time we have a transaction, we're going to use a system of debits and credits to record that transaction. So instead of sitting there on that spreadsheet where we said, okay, assets will increase, okay, run over here, let's, increase stockholders' equity or increase liabilities or whatever, increase revenue, whatever, we're going to use a system of debits and credits to accomplish that. Okay? Now, this system has been around since the 12th century, and as I said, it is very effective to use, and it is fairly easy to use once you put in sort of the weightlifting stage to get used to how to use this. Okay? So it's debits and credits. Debits equal credits. Every transaction, every business transaction will have a debit and a credit, and those debits and credits will what? Equal each other, and that will keep the equation assets equal liabilities plus stockholders' equity in balance for us. Okay? Now, you look at this slide, and you're going to sleep with this one under your pillow. You're going to sleep with this one under your pillow. You've got to know this. There is no way to not know this slide. In fact, this is a little harsh for you guys because my Stanford students do learn this slide and they do pass the class overwhelmingly. Some of my other schools, they resist and resist and they end up not passing the class. I have not had that at Stanford, okay? So forgive that harsh note up there. It's not really intended for you, okay? But if you take a look here, we are going to look at these debits and credits. You got to know this. These debits and credits as either plus signs or minus signs. Debits can be pluses. They can be minuses. Credits can be pluses. They can be minuses. It depends on the account that we're talking about. Okay? So if we're talking about an asset account and we want to increase that asset account, we bought equipment, we want to increase the asset account, we debit it. We debit an asset account to increase it. If we want to decrease an asset account, we will credit it. If we're talking about a liability, notice it moves in the opposite direction. If you want to increase a liability, you will do what? Credit it. If you want to decrease it, you will debit it. Okay? If we're talking about our revenue, if you want to increase a revenue, you will credit it. If you want to decrease a revenue, you will debit it. Expenses, if you want to increase them, you will debit them. If you want to decrease them, you will credit them. Okay? Our stockholders' equity, if you want to increase your stockholders' equity, you will credit it. If you want to decrease it, you will debit it. Yes, sir.
What does it really mean to credit something or debit?
It means that if we're increasing it, we bought equipment, and we're trying to increase the balance in the equipment account, we debit it. That debit causes it to increase. Okay? So it's a plus sign. If we are talking about an asset that we're getting rid of, we've spent some cash, we obviously want our cash number to decrease, our cash account balance to decrease, we will credit it. Okay, so these debits and credits sit here and they function as plus and minus signs, obviously, depending on the account. Okay, now, when you look at this, you should be able to do this from memory. So if I want to increase an asset account, I do what? I debit it. Good. If I want to decrease it, I credit it. Good. If I want to increase a liability, I credit it. If I want to decrease it, I debit it. Good. If I want to increase revenue, I will credit it. If I want to decrease it, I will debit it. Good. If I want to increase an expense, I debit. Good. If I want to decrease it, I credit it. Good. Stockholders' equity, I want to increase it, I credit it. I want to decrease it, I debit it, right? Okay? All right. There is no way to get through this class without knowing how to increase assets, how to decrease them, etc. No way. So, here's what you do. You print this out. You sleep with it under your pillow. So you wake up in the middle of the night, you look at it, right? You wake up in the morning, you look at it before you go to bed. Good night, assets. Good night, liabilities. Okay? You get on the bus to go home today. Someone sits next to you that you wish wouldn't sit next to you. You look at them and you say, do you know to increase assets, you debit them, to decrease them, you credit them, to increase liability, you credit it, to decrease it, you debit it, to increase revenue, you credit it, to decrease it, to debit it, to increase expense, you debit it, to increase you credit it, to increase stockholders' equity, you credit it, to decrease you debit it? I promise you they'll move. Okay? All right. You walk in the house. Hi, honey, I'm home. Did you know to increase assets, you debit them, to decrease them, you credit them? Okay? If I'm lucky enough to live to be my dad's age, I would probably be sitting in a park somewhere feeding the squirrels, whatever. They'll say, what's your name, sir? I'll go, to increase assets, you debit them, to decrease them, you credit them. Okay? That will be the last thing to go. Okay? It is not a memorization thing, guys. You kind of start to memorize it, but at some point it's got to become a reflex. It's not one of these things that you can say, oh, I'm going to just memorize this, or, gee, can we have a cheat sheet in the class that tells that? It doesn't work that way. You will never get there that way. It's got to be a reflex that you know what to do when you are trying to increase an asset. You debit it. You know what to do when you're trying to decrease an asset. You credit it. Okay? All right, so you got to know that, but this does you no good if you don't have this slide. This slide calls out to you the accounts that constitute assets, liabilities, revenues, expenses, etc. Okay? So, when you look at this chart of accounts, you have to know this as well. So you have what? Assets. Is cash an asset? Is cash an asset? Okay? Future economic benefit, right? Accounts receivable, supplies, prepaid insurance. We'll talk more about this, but if you pay your insurance bill and it's going to last you a year, then you've prepaid that for a whole year, haven't you? Does that have future economic benefit? Obviously it does if you prepaid it, so prepaid insurance is an asset. Equipment is obviously a what? Asset because it has future economic benefit to it. Liabilities, our category, these are our categories, aren't they? Assets equal liabilities plus stockholders' equity. But under the what? Under the categories, we have accounts. This is a chart of accounts telling you which are assets, which are liabilities. Liabilities are pretty easy. Notes pay a bill. Accounts pay a bill. Okay? Salaries pay a bill, interest pay a bill. We'll talk about unearned revenue here as we go through our little example that we're about to go through, and that is a liability as well. Revenues are what? Revenue. You can usually tell that it's a revenue account because it has the word revenue in it. Expenses, you can usually tell which are expenses because they have the word expense in them. Okay, those show up where? On the income statement, right? And then we look at stockholders' equity, and right now, stockholders' equity is common stock, retained earnings. We're listing dividends under stockholders' equity simply because it's what? Our dividends are paid out of retained earnings. And then we're going to learn something about this account called income summary here as we go through our example today. Okay? All right, so you've got to know these two slides, guys. These two are critical. I would print both of these and keep them with you. You get stuck at Costco. You guys go to Costco? Okay, you can't get out of there. You're stuck in line, something. Bust these out. You get invited to a party. Bust these out, okay? When I used to get invited to parties 30 years ago, I would always bring these with me, okay? All right, now you go ahead, and some of my jokes you get on the way home. Oh, I see, he doesn't get invited to parties anymore because you brought this with him. It was 30 years ago. Okay, all right? Okay, now you take a look, and we've listed this as to how the debits and credits increase, decrease the various accounts. So sometimes students find this helpful because it combines the accounts with the debit and credit increases and decreases. Okay? Okay, good. Now you come over, and our process that we're going to practice with in accounting is this. You first analyze a transaction. And I don't know why this guy needs a magnifying glass to analyze the transaction because we're not going to go that deep. You're going to see what the transaction is and you're going to say, oh, okay, they purchased an asset, so I have to increase assets, right? They spent some cash, so I have to decrease cash, right? So you'll look at the transaction. Then you will go ahead and enter the transaction into a journal. And then once you've entered that transaction to a journal using debits and credits, you will go ahead and post those debits and credits to your ledgers. Okay, so we're going to enter transactions in a journal. We're going to post them to a ledger. Now let me warn you, the example that Smita is going to hand out now is a bit tedious in how we're going to go through this process. So we're going to go through it slowly, manually showing you how this is done. The promised land is that we're doing this so we understand how the process works. In the real world, whatever, we would use computer system to do this process, which will take much of the tedium away. And I'll probably show you how we would use a general ledger software to accomplish the thing that we're going to be doing manually here together. And you'll see that it's much easier than the tedious process that we're going to go through. Now, I'm going to go through this slowly. If you have questions as we go along, this is a good time to, pick my brains, whatever, squeeze whatever you can out of me to understand this. I mean, this is the whole point of this exercise that we're going to do. Okay, and it's coming around right now. So I'm going to show you that the exercise that we're going to go through looks like this. And so you should see in front of you something that shows cash and common stock, $1 million. We just handed out. Everybody got a copy of that? Any extras? We can go ahead and get the extras so if we got extras. Everybody's got one? There's one gentleman over here on the far right. Okay, everybody has it? Yes, sir.
Just to be clear, debits and credits are not what we typically think of. Debit buying something, you have to pay versus credit.
I'll tell you what. Hold that question for a couple of transactions here, and then I'm going to answer it. Okay, because I think it'll be more meaningful to you if you have a little bit of this under your belt, and then it'll make more sense to you. Okay, but that's a good question. I'll answer that here after about the third transaction. All right. Okay, everybody has this? Okay, good. So what I'm going to do is come out of the slideshow mode because it's easier for me to show it to you on the actual Excel spreadsheet. Okay, so you have the printout of this in front of you. And so I'm just going to go into Excel to show you how this thing works. Okay, all right, good. Now I go to year one. Okay, and focus, guys. You got to focus here. So I know that it's, sometimes fun to talk to the person next to you, but I'm telling you, if you drift off, you're going to be like, I don't understand this. And it's that 2 or 3 seconds that you turn to say something to your friend is the one that's going to cause this thing to collapse on you. So focus up here, okay? And in this first one, we say that the company issued common stock for $1 million of cash. So cash has come into the company, right? We're forming the corporation. Now we're bringing cash in. Instead of bringing lemons in, we're bringing cash in, which is commonly the case, okay, when we start a corporation. So we go ahead and we debit cash for $1 million. When we debit cash for $1 million, that increases the cash. And since we're issuing stock, we have to increase our common stock, just like when Ray and Barbara Neal started SoftBite or whatever, they increased the cash, they increased the common stock. But instead of just writing a plus and a minus under those columns, we're going to use our process of debits and credits, our system of debits and credits. We debit cash $1 million, we credit common stock for $1 million. Now you look at this and you say, John, how do I know that that's a debit to cash and a credit to common stock? Well, let me back up. First off, we understand that to increase an asset, you debit it, don't we? And we understand to increase the stockholders' equity, we credit it. Okay, so we debit cash, we credit common stock. That increases both of those, right? Okay. Now you're saying, how do I know that what you have typed in on that far left side was a debit to cash and a credit to common stock? Ready? Debit on the left, credit on the right. Debit on the left, credit on the right. So if you look, this transaction right here, issuing common stock, issuing common stock right here, this transaction right here, if you look at it, it was what? It was the debit to cash, both the word and the number are to the left, and then what? The credit to common stock is indented to the right of the word cash, and the $1 million is indented to the right of the $1 million debit to cash. Debit to the left, credit to the right. The word common stock is indented to the left of the word common stock is indented to the right of the word cash. The $1 million that's going to common stock is indented to the right of the $1 million that's going to the cash, right? Question on that? Debit on the left, credit on the right, okay? Now, as we said in our slide, that is an entry that we are making into our journal. So we record the transaction in our journal. That's this stuff that's on the far left-hand side of the spreadsheet. That's our journal. And then we will post to our ledger. We will post to our ledger. Now, when we look at our ledger over here, we have listed our accounts under the category of asset, liability, stockholders' equity, and then we've got revenues, expenses, etc. Okay? So we've got these different accounts, and we find the account that was associated with that transaction, and there's our cash, isn't it? So now we post over to the ledger. Now, when you post over to the ledger, guys, it is a very mechanical process. Did we debit cash here? That's a debit to cash because it's to the left. We take that $1 million number. We put it there. Is it there now? We write it there, and when we do, boop, the system shows us that our cash balance is $1 million. Does it work? We increased cash by debiting it, didn't we? Okay. Then what? Then we go ahead and we do the same thing with the credit for the common stock. Common stock is one of our stockholders' equity accounts, isn't it? So we come over to stockholders' equity. We pick up the $1 million credit to common stock. We pick up that $1 million credit to common stock. Pick up that $1 million. We put it there, don't we? And when we do, the common stock balance shows how much? Shows $1 million, doesn't it? Okay. Now, if I were to prepare my balance sheet right now, what would it look like? Don't write this down, guys. Don't put this down because this is just an example, and we're going to actually do a whole balance sheet here in a minute once we finish the first year's worth of transactions. If we were to sit here, though, right now and make up my balance sheet, just looking at cash, just that one transaction now, we're just assuming we've just done this one transaction. So I've already posted the transactions for all of the journal entries because I don't want to sit here and do them one at a time. We'll be here all day. So you have to sort of suspend your imagination. Right now we just have the debit to cash, the credit to common stock, and the resulting balance of $1 million in cash, $1 million in common stock. So do I have any assets in this company at this time? What do I got? Cash of $1 million, don't I? So I go ahead and I write the cash, $1 million. Do I have any liabilities? And at this point, you may look up there and say, oh, I see liabilities, but presumably these transactions that are affecting liability haven't happened yet, right? Okay, so do I have any liabilities? Liabilities would be 0. Do I have any stockholders' equity? Stockholders' equity, I have what? Common stock of $1 million. Does the balance sheet balance? Does the balance sheet balance? So it works. This system of debits and credits, for every debit there's a credit, keeps the balance sheet in balance, doesn't it? Okay. Okay, good. So I went ahead and I finished that transaction. I'm going to erase this. Maybe I'll leave that common stock down there. But I'm going to erase the rest of it. Okay, and then let's go ahead and let's look at this next transaction. And it says here that we purchase a building. We purchase a building. That's our second transaction. We purchase a building for $1.2 million and signed a mortgage liability for $200,000. Now what happens here? We go to the guy and we say we want to buy a building for our business. We're going to use it in our business. And the guy says, okay, I want $1.2 million. And we tell the dude, well, we only have $1 million. Will you take $1 million? He says, no. I got 10 people lined up out there that are ready to pay $1.2 million for this thing. So we say, okay, look, we really want the building. How about we give you $1 million down payment, and we'll pay you the $200,000 over the next 30 years or something stupid like that. And the guy says, great, okay, no problem, because most people aren't going to cough up $1 million cash. So he picks us as his buyer, right? So what happens? We're getting the building, but the building is worth $1.2 million. That was the cost when we bought it, right? So what do? We go ahead and we debit building. Is a building an asset? Is a building an asset? To increase it, we debit it. How do we know we're debiting this? Because we wrote the debit to the left, didn't we? And we credit what? We credit our cash for $1 million because we are reducing our cash. We're going to pay out $1 million of cash, right? But we have to recognize that we have this mortgage pay-up bill is a liability, isn't it? Mortgage pay-up bill. Okay? And so what happens when we go ahead and post those, we debit building 1.2 million. Now my building's showing 1.2 million. That's what I paid for that building, didn't I? Cash plus the liability I'm taking on. So I paid 1.2 million for it. I credit cash, and when I credit cash for $1 million, the balance in cash comes down to 0, doesn't it? Because I paid my cash. Debit to the left, credit to the right. And in our ledger, you can see that I actually wrote debit and credit on top of here because that's common in a ledger. In the journal, you don't call out debit and credit because everybody knows debit to the left, credit to the right. Okay? But I go ahead and I post that to my cash. My cash account is now 0. And then for my liability, I take that $200,000. I pull it from my journal, I walk over here, and I go ahead and I stick it in mortgage payable $200,000. So now I know I have a liability of $200,000, don't I? Okay. Now when I prepare my balance sheet, do I have any assets, guys? Now cash is how much? 0. But now I have what? Again, we're going, we have to suspend our imagination, pretend the other transactions that we're showing here haven't happened yet because we're going to go in order here. My building is $1,200,000, isn't it? Just picking that up? Okay. How about liabilities? Good. I've got a liability, which is this mortgage payable of $200,000, right? Do I have any stockholders' equity? Do I have any stockholders' equity? Common stock of $1 million, right? Focus up here, guys. Common stock of $1 million. Does my balance sheet balance? My balance sheet balances. The system works, doesn't it? Okay. Now, mort in Spanish means death. So mortgage payable is basically saying, hey, you're going to die before you pay this thing off, right? It's a very long-term liability that will take us a long time to pay off, right? That's why they call it a mortgage payable. But it is a liability, isn't it? And we credited that to increase that, right? Okay, now the question was, is this the same thing as what you might get from the bank when they say, you made a deposit and we credited your account? You may hear that from the bank. And what the bank is describing to you is their accounting. They're telling you they credited your account because if you deposited money with them, their cash went up, they debited cash, and they credited the liability that they owe you that cash if you were to come to the bank and try to withdraw it, right? So they have a liability there. So they're describing to you your accounting. In your business, you would do what? You would debit cash and credit whatever service revenue or whatever that you had done at that point in time. So when companies tell you we've credited your account, etc., that is them describing their accounting to you, not your accounting that you should be doing for your business, whatever. Does that answer your question? Okay, so it's kind of related but different. Okay, okay, good. Now you come over and you take a look at the next transaction, which is, I guess we decide we want a vehicle to run this business. What kind of business is this anyway? Let's say it's some sort of DJ business, okay, where we go to different parties and stuff and we do the DJing. And so we decide that we need, we need a vehicle to move our stuff around, right? So we go and we get some really fancy truck, I guess, or maybe we're going to have a limousine so we can show up as DJ Wild or something and jump out of the limousine. But we need what? We need a vehicle. So we go to the dealership and we say, okay, this is the car we want. And the guy says, okay, 150,000. And we say, you know, we don't have any cash. Will you let us take the vehicle on credit? Will you let us take the vehicle and not pay you until later? Can you do that? Absolutely. If you've got the credit, trust me, when LeBron James walks into a car dealership, they don't say, well, do you have the cash, Mr. James? You know, he pulls out his double platinum American Express card and puts the whole thing there and just pays it off later, right? Or pay the dealer later, okay? So the dealer says, okay, let's run your credit. They see some assets showing up there. They see that building for $1.2 million. Our credit's good. He says, no problem. Go ahead, drive the car off, pay me later. Okay? Do we have control of the asset? The vehicle? We have control of that vehicle asset. We're going to what? Use it in our business. It has future economic benefit. It is an asset, so we do what? We debit equipment. How do I know I'm debiting it? Debit on the left. And I credit payment payable, vehicle payable. I obviously have a liability, don't I? I have a bill. So I credit that to increase the liability. Then I come over here and I do what? I post. I pick up the debit here. I stick it here. Is the vehicle now showing 150,000? Okay. Then what? Then I go ahead and I take the credit and I post the credit under my liabilities to vehicle payable, 150,000. I credit that. Now I'm showing that liability in my ledger, right? Post them to the ledger? Question? No? Okay, good. Question? All right, good. I'm not going to make the balance sheet again, guys. We'll do a balance sheet here at the end, okay? All right, now I'm going to go to my next transaction, and I'm going to provide service worth $200,000. So what happens? I don't know. I go and I do the DJing concert, and the party thrower or whatever says, okay, here's your 200 grand. Not bad. We must be pretty happening DJs, right, that they're paying us $200,000 for a night's work. So we go and we do that. They give us, we're better than that dead mouse, right, or whatever. So is that what they call it, dead mouse? So what happens? I don't know. This is your guys', era of things. I look and I'm like, why is Mickey Mouse drunk? Okay. So anyway, so what happens? When did Mickey Mouse get possessed by evil spirits? Okay. So what happens? We sit here and we perform the concert. He hands us $200,000. The party thrower hands us $200,000 cash. Now, when that happens, we go ahead and has our cash increased? So to increase cash, we debit it. Debit on the left. And when we post that, and I'm just going to go ahead and post it right now just so that we have the immediate effect on our accounts, we take that $200,000, we post it here. Our balance in cash is now $200,000, right? Because we got this $200,000. Isn't that beautiful? Okay. And then what? Then we credit revenue. And to increase revenue, you credit it, credit on the right. We post it over here, and now our revenue is showing $200,000 for the year, isn't it? Not bad? Okay. Now, I'm not going to redo the balance sheet right now because I'm just going to wait till the end to do the balance sheet after we put all the transactions in the ledger, etc. But let's go ahead and let's make the income statement real quick. So, I don't want highlighter for that. So, income statement. And what shows up on my income statement? Revenues minus expenses. And then I'm going to show my net income, right? So right now, my revenue is showing at $200,000, isn't it? Now, presumably, guys, I know you can see expenses under there, but you have to use your imagination. Right now, my expenses would be zero because I haven't paid any expenses yet. So if my expenses are zero, my net income is $200,000, isn't it? Because I don't have any expenses. Okay? All right, good. So I go ahead, I had that work that I did the concert, whatever. But remember, I got to get my equipment to the party, don't I? And so I hire some really big guys, you know, these lift guys, whatever, come, and they help move the equipment. And at the end of the night, they say, hey, boss, you got to pay us before we go home. And I'm thinking, oh, okay, well, I don't want these guys hanging outside my front door all night. So here you go. And I pay them $70,000 cash for the work that they did, right? But, God, got rid of them, right? So I go ahead, and since I've paid them $70,000 cash, let's just look at the cash first. Has my cash decreased? Has my cash decreased? I paid those guys $70,000, so I credit cash, credit on the right, and then I post that to my ledger. Now my cash is what? $130,000, isn't it? Is the system helping me keep track of my cash? Okay. I debit my expense. To increase an expense, you debit it. Haven't my expenses gone up? And it's expired because at this point, these guys are gone, aren't they? Try to stay awake, guys. I'm telling you. You drift off, and you think it's okay to drift off, and you wake up, and you're going, when did John start speaking Spanish? You got to hang with this thing, okay? You got to do this. This example, year 1, year 2 example, is going to be the definitive document. We're doing year 1 now. We'll do year 2 here, assuming we have time. Is going to be the definitive document that is going to help you to understand everything you really got to know for this class, okay? Question?
Why is this not a liability? It's because it's not like a recurring expense.
It's not a liability because I'm paying them cash now. If I said, hey, I'll pay you later, then it would be a liability because I'm going to pay them, say, next year or something, right? But these guys were pretty tough, and they were pretty adamant about getting the cash now. So since I'm paying them the cash out now, my cash is coming down right now, right? So I have $130,000 cash left at the end of this transaction. Okay, and it's an expense. It is expired because those guys are gone. They already did the work for me, didn't they? I mean, it's not like they're going to come back later and do more work. There's no more future economic benefit associated with that transaction, that activity, so I'm going to show the expense, right? So I debit expense for $70,000. When I do, my expenses balance goes up $70,000, doesn't it? And it's $70,000 right now. Okay, you have to ignore some of those other transactions. We're going to deal with them in a minute. So I'm saying right now that my expense is $70,000. So if I put that on my income statement, expenses of $70,000, now what's my net income? Now what's my net income? I'm sorry? $130,000? Everybody? $130,000 my net income now? Okay. Okay, good. So I'm done with that transaction, and I have now come to the point where I want some of the cash that is in this company, and I want to draw it out as an owner. And so I'm going to divide the earnings amongst my owners right now. Maybe I so happen to be the only owner, whatever, but I want some money. So I say, you know what, I'm going to take about 10% of the earnings for this year for my own personal account so I can go and have some beer. I don't know, whatever. I can go and buy dinner, whatever. I can buy myself a cheap car to ride around in my own personal use, right? And so what do? I go ahead and I pay myself a dividend, and when I do, I credit cash for 13 because I'm taking the cash out of the corporate accounts and putting it in my own personal pocket now, right? And so when I credit the cash balance comes down. That's no longer in the corporate account. That is now in John's pocket, isn't it? So I credit that 13,000 because I've drawn. And I debit this account called dividend. I debit dividend 13,000. And I go ahead and post that debit. So I know that this year I paid what? 13,000 of dividends, right? So I've got my income statement. Revenues minus expenses is net income. And now I can go ahead and prepare my statement of RE is retained earnings? I've got my income statement, don't I? But remember when we were looking at those statements, we looked at an income statement, we looked at a statement of retained earnings was the next statement we looked at. Okay? So when we look at our statement of retained earnings, we start with the beginning balance. Beginning balance is 0. We just started the business, didn't we? So there was no retained earnings because we just started the business, right? Then we add what? What do you add to retained earnings? What do you add to retained earnings? Good. We add the net income. If I'm asking you guys, just so you know, I'm not asking you because I don't know the answer. I'm asking you so that you can run it through the speech center and tell me. So I'm not asking you because I don't know. Sometimes I think my classes are like, look at him. He doesn't know what the add is to retain earnings. Don't tell him. Let's see him. Let's watch him sweat it out. Okay, if I'm asking you, it's because I want you to show me that you know. And so my net income is 130, so I add that, don't I? Net income? Okay, what do I subtract from my retained earnings? Good. I subtract the dividend, which is 13. That says dividend, which is 13,000. I subtract that, and that gives me an ending balance in my retained earnings of 117,000. That's my retained earnings? Okay, good. Now I can go ahead and prepare my balance sheet. Isn't this beautiful? And we're sitting here and this is creation. There was dust. There was nothing. There was a blank spreadsheet. And now we've sat here and done debits and credits, and we have a set of. Is there anything more beautiful? I mean, this is better than a sunrise, isn't it? Okay. All right. So we have assets, and we start to look at our assets. Do we have any assets? Do we have any assets? Cash is an asset, so we put in our cash. How much is the cash balance? I mean, preparing the financial statement is the easiest part of this whole thing, isn't it? You just look to your ledgers and you see what the balance is in all these accounts, isn't it? It's a piece of cake. Okay. How about what? Any other assets? Equipment? That's that vehicle is 150,000. Any other assets? Good. We've got the building. Building is 1,200,000. Right there. Any other assets? Any other assets? I don't see any others, so we're just going to go ahead and do what? Total this. What's the total? This is the part where you want to use a calculator, guys. I don't know what the total is. In accounting, you need to be used to adding numbers up. 170,000 plus 150 plus 1,200,000. Huh? 1 million what? 1,467,000. Okay. Now, for some reason, I don't know why, all of my classes resist me on pulling out the calculator and adding up these numbers along with me. And they resist and they resist and they resist. And then when they're heading into the exam, they say to their room, oh, can I borrow your calculator? And they get a calculator and they come in here with a calculator they don't know how to use. And they get, why is it flashing? I don't understand what these buttons are doing to me. You need to start bringing it and using it, and then use that one on the exam so that you're not sitting there struggling on the exam day with a strange calculator. But in accounting, the expectation is you bring a calculator and you work along, okay? Okay, good. So you have 1,467,000. Okay, that's my total assets. Is that my total assets? Okay. Okay, good. Let's go ahead and let's do the liabilities. And do I have any liabilities? I have a mortgage payable, right, of 200,000. Do I have any other liabilities? Vehicle payable, good. That was 150,000, right? Just picking that number up. Oops. Okay, that's 150,000. Any other liabilities? Mortgage payable, vehicle payable, that's it, right? Okay, good. So when I add those up, and I guess that one even I can do in my head. Good. Total liabilities 350. Right? Okay. So I'm on the balance sheet, so now I have to include my stockholders' equity, don't I? Stockholders' equity. And stockholders' equity consists of what? Consists of common stock and retained earnings, right? So do I have an amount in common stock? So common stock is $1 million. With me so far? Now, at this point, I have not done any debits and credits to my retained earnings account. There's nothing that I've debited and credited in retained earnings. You go back and you look at the transactions that we looked at so far, and there was no debit to retained earnings, there was no credit to retained earnings. So right now, retained earnings would be showing 0, wouldn't it? If I haven't debited or credited anything to retained earnings. But because I've already prepared my statement of retained earnings by taking the beginning balance plus my net income minus my dividends, I know what the balance should be, don't I? It should be 117,000. So I'm just going to go ahead at this stage and pick up the retained earnings, what I know the ending balance is supposed to be, which is 117. I pick that up from my statement of retained earnings, and I put in my retained earnings as 117, right? And so now my total stockholders' equity is 1,117,000, isn't it? Okay. And when I add my liabilities plus my stockholders' equity, I have this total liabilities plus stockholders' equity down here. Total liabilities plus stockholders' equity, if I do the math, should be what? 350 plus 1,117,000 is how much? 1,467,000. 1,467,000. So does the balance sheet balance? Isn't it beautiful? The balance sheet balances, doesn't it? Question?
I have a question about the letter. So under revenue, it says that you debit it to an account.
Well, we're not there yet. So far, all we've done is credited it. Okay, again, I didn't want to sit here and have to put each transaction in as we went along, so I kind of filled it out ahead of time. So right now, it's only $200,000. Okay, and that's what I used to make the income statement. Okay, we're going to get to these other transactions right now. Okay, because what's happened? Well, right now, the balance, and I probably should have presented this a little better, guys. But right now the balance in retained earnings is 0 because there have been no debits or credits to retained earnings. And I can't just go up and put an amount in retained earnings without having a balance of debits and credits. So what I'm going to do is go through what they call a closing process. Okay, I'm going to go through my closing entries right here now. Okay, so these ones down here are going to be my closing entries. Okay, now what do closing entries do? And if you were drifting off, you absolutely got to come back now because this is the part where everybody falls off of the ship. Okay, we're heading into stormy seas here, and so you got to be awake. You can't be asleep now because you will be in a position where you're not going to be able to hang with this class if you don't follow this part. Okay, so what happens? We have to do the closing entries. These closing entries accomplish two objectives. One is to close my revenue and my expense accounts to 0. I want them to be 0 at the end of the year so that they will be 0 next year when I start keeping track of my net income next year because I start all over again, don't I? Don't you report net income by year? So I have to close my revenue and my expense accounts to 0. So I'm going to close those. That's one objective. I've got to close my same objective. I'm still on the same objective. I have to close my dividend account. And I have to close my dividend account because I keep track of my dividends by year. Companies, when they tell you how much dividend they paid for a year on their statement of retained earnings, they're not saying these are all the dividends we've paid ever since we were born. This is the dividend we paid this year. So I need to close that back to 0 so I could start to keep track of my dividends that I pay next year starting at 0. So I'm trying to 0 out my revenue, my expense accounts, my dividend accounts. That's objective 1 of the closing. The other objective of the closing entry is to get my net income minus my dividends effect up into retained earnings. Because right now, if I look at my ledger, my retained earnings is showing 0, isn't it? Even though my balance sheet that I prepared is saying 117, it's because I peaked at the statement of retained earnings and just pulled it over, didn't I? But I want my ledger to match what's in my balance sheet for my retained earnings, okay? So I sit here and I start to go through the closing entries. And when I go through the closing entries now, my revenue I had credited during the year when I did my concert, when I performed my service, whatever, right? I credited it. So if I want to turn it back to 0, I need to what? Debit it. Good. I need to debit it for $200,000, and that will do what? I debit it here, and when I debit it, just peeking over at the revenue account, I debit it. Is revenue 0 now? Is that what I want it to be? I've got my income statement prepared, so I don't need to know what it was for the year anymore. I'm turning it back to 0 so we can start next year, right? So I do that, and when I debit revenue, in that same entry, I credit income summary. I come over to this account income summary. I credit it for 200. I post that credit. And right now, my income summary account is showing me what my revenue was for the period, right? 200,000 is the balance there. But I also have to close my expense accounts. I want those to go back to 0. So I go ahead, and during the year when I paid those guys, I had debited expense, right? If I want to turn it back to 0, I want to decrease it, so I'm going to credit it 70,000. When I credit it 70,000, does it go to 0, which is what I want? I credited 70,000. I post that credit. It is now 0. During the year, I debited it. That brought it up to 70,000. To close it, I'm crediting it. That brings it to 0, right? So it's at 0. And then I go ahead, and in the same entry where I credited expenses, I debit income summary. I post that debit to income summary. And when I do, now the balance is what? 130,000? So income summary is showing me my net income for the period, isn't it? It's kind of a cool account because for a minute it says, this is what your net income was. 130,000 was my net income. But I also want to close income summary because I want to keep track of my income by year, don't I? So I want that to go back to 0 so I can start to keep track of my net income for next year, right? So I go ahead and I debit income summary now for 130. When I debit income summary for 130, it goes to 0. That's where I want it. I want it to be 0, don't I? And I go ahead and I credit my retained earnings. Now I have finally done a journal entry that affected retained earnings. I've credited retained earnings, haven't I? So I come over and I post to retained earnings for 130, and the balance comes up to 130, doesn't it? So when you think of income summary, it's really just a holding place for my net income so I can then take it to retained earnings, right? My net income was sitting in there when I did my closings of my revenue and my expenses. I ended up with my net income stuck in income summary. And the net income says, hey, help, help, help. I'm stuck inside of income summary. Can you give me a ride to retained earnings? And I say, sure, no problem, net income. I do what? I debit income summary. It's out, isn't it? And it gets the ride to retain earnings now through the credit to retain earnings. Now my retained earnings showing 130. I got my net income in retained earnings, didn't I? Which is where I want it to be. Now I just have to do what? Now I just have to close my dividend account because I want that to be 0. Now, when I paid the dividend, I did what? I debited dividend when I paid it. To turn it to 0, then I have to do what? Credit the dividend, don't I? And when I credit dividend for 13,000, that brings this to 0, which is what I want it to be because I'm going to keep track of my dividends by year. So dividend is now 0. I debited when I paid it. I'm crediting it now. It's 0, isn't it? Which is what I want. And notice I go ahead and I debit my retained earnings. To decrease the stockholders' equity account, you debit it, don't you? So I go ahead and I post that debit to retained earnings. And now retained earnings is showing me 117. Is that what it's showing on the balance sheet, the 117? So that matches now. My net income added to my retained earnings, my dividend subtracted from my retained earnings, ended with that balance of 117. Yes, sir.
So with dividends, when you paid them to the stockholders, that was coming out of like that was debited from like that money, or when you got the money, it came from the stockholders, and then when you had to pay out the dividends, then you
First of all, I don't have to pay out dividends. I choose to pay out dividends.
sure. So when you do that, then you take that out of whatever's liquid, and in this case, it's retained earnings. Is that right?
No. I paid it out of cash, didn't I? I paid him cash. I credited cash. I debited the dividend. So I paid him the cash, right? My stockholders have the cash. The cash balance in the corporate accounts came down from 130 to 117, right? When I paid him the dividend. Okay? And if I pay a dividend, am I retaining my earning? If a corporation pays its dividend, is it retaining its earnings? It's paying them out, isn't it? Well, I'm reducing my retained earning because I haven't retained it anymore, right? So when I paid the dividend, I debited dividend, credited cash. When I did my closing entry, I credited dividend to turn it back to 0. And I debited retained earnings because my retained earnings decreased because I'm not retaining that earning anymore. And to decrease the stockholders' equity account, you debit it. And that's exactly what I did. I debited retained earnings. Yes, sir.
What's the difference between paying a dividend and debiting the common stock?
I wouldn't debit common stock. I would debit an account called treasury stock. And the difference is that one is a payment of a dividend in cash. Treasury stock is a repurchase of the company's own stock on the open market. they go out and they buy the stock. That's Chapter 11. They go out and buy the stock on the open market. Hang on, guys. Hang on. Now, okay. Now, this is like in a test the emergency broadcasting system. Okay, this example is critical. You have to understand this example. Okay, so I'm going to give you some advice. What's today? Wednesday, right? Okay, over this weekend, you should go through this example again, seeing if you can figure out what the journal entry is for each transaction. And if you look on Canvas, I have a blank example of this, a blank copy of this example. You should sit with the recording, and you should sit there and pause the recording for each transaction, see if you know what to do, and then hit play and see if you got the answer right to go through this again. When we come back on Monday, we're going to refresh our memory on year one, and we're going to see now how this will flow through to year two. I can't say enough how critical understanding what happened up here is to your success in this class. So make sure you're looking at this little example, getting comfortable with it. If you're having some issues, know what those are so you can start to ask about that on Monday and stuff. Don't let it just roll you over, because this will. This will roll you over, and you'll be sitting there saying, I don't understand what's going on in this class, and I can point back to things that you don't understand in this example that are going to be problems for you, okay? So make sure you look at that. Have a good weekend, and we'll see you on Monday. Make sure you signed in, please.